Hello and welcome to More Than Commas, where we help you make more informed financial decisions in pursuit of living a great life. I'm your host, Cory Shepherd, and today we're going to talk about the S&P 500. Now, the first thing I want to get out of the way is this is not an anti-S&P 500 episode. We shouldn't have any of those. The S&P 500 is a great asset class and lots of rate of return is available, or potential rate of return is available as an allocation inside of a portfolio. What this podcast is about is going all in on the S&P 500 and the dangers inherent therein. And it's because we've seen over the past span of years, the S&P 500 have an amazing run. And so from time to time, we hear folks talk about, well, should I just call it good in the S&P 500 index and just put all my money there? So I'm going to give you some data from the past and just to give us a sense of why that might not be the best solution for an individual's portfolio and some of your individual goals. My first stop for us is to talk about the Magnificent Seven. Now, the Magnificent Seven are Tesla, Meta, Alphabet, Amazon, Nvidia, Apple, and Microsoft. And that helps me get these disclosures down here for our podcasting purposes. So this screen is looking at the Magnificent Seven versus the S&P 493. That's the other 493 stocks inside of the S&P 500. And in 2024, you can see that the Magnificent Seven returned 48% compared to a paltry 15.9 in the rest of the S&P 500. That's still a pretty darn good rate of return on an annual basis. And then as just another control, the MSCI All Country World Index ex-US, so basically a little bit of everything else out there in the world that's not the United States, 5.2%. Now, 2024 was a great year for US-based companies. That's what I see here on this chart. Look at 2025 year to date, and that's year to date as of March 12th, 2025. Negative 12.3% for the Magnificent Seven, negative 0.8 for the other 493, and very similar to 2024, a 5.9 rate for the MSCI All World Index. So we're seeing that the S&P 500, which used to be a very diverse mix of 500 different companies across varying industries in the United States, is now very dependent on tech companies, many of which operate in very similar spaces and are going to be very interconnected with each other as far as the impacts on those countries when any one thing happens out there in the world. Stop two is looking at some different sample periods for the S&P 500 versus other asset classes. This is an example, is the S&P 500 versus a US small cap value index from Dimensional Fund Advisors. Now, we're also not recommending going all in a small cap index either. Foreshadowing to the end, the point that we're trying to get across is different assets with different behaviors and different risk profiles combined together into one portfolio produce a better investing experience for the individual investor. So we're not saying go all in or all out of any of these, but looking at a way to combine them more efficiently over time. So 1927 to 2023, the S&P 500 averaged 10% per year, 10.1, and the small cap index averaged 13.1. So 30% outperformance by small cap over a really long period of time, including all of the major market calamities that we talk about the most in our modern history. Since 2010, and this is what recency bias does to the human brain, folks have been focusing on the S&P outperforming a lot of other asset classes, and it's doing 12.5% since 2010 versus 10.8 for the dimensional small cap. So again, the looking at sample periods is really important, because the other one that an individual investor really needs to think about is this lost decade from 2000 to 2009. That's where, famously in market history, if we're paying attention, the S&P had a 10-year period where we actually were losing money if you held it for that entire period. And that's mainly because of the mortgage crisis dropping so much that it brought that average down. But over that same 10-year period, small cap was averaging 12.3. So it's one thing to say a rising tide lifts all boats going back to 1927. That is true, although that's a longer investment horizon than most individual investors will actually be investing and drawing, especially drawing income over their lifetime. It is another to say, what if the next 10 years was not only zero, but slightly negative? What would that do to my portfolio? If we can hang in there for the long term, yes, we may break through that 10-year period and be just fine. But what are the chances that someone can hang for 10 years being negative and also never needs to pull out any of that money to do anything with during that time period? These are the things we have to think about when real life comes into a portfolio. So this is a sheet that lets us compare different portfolios over time. And I want to say, just on the front end here, that back testing as a tool for picking the portfolio is not particularly useful when we're saying, hey, we can beat the market with this great portfolio. Look how good it did against something going back 20 years. Because there are ways, just like, unless you're Bill Gates, there's always someone richer. But of course, now there is someone richer than Bill Gates. There's always a portfolio that would have beaten yours over a certain time period. There's always some asset class that outperformed. And if you balance a little bit to that direction, we're not trying to do that. We're trying to build a portfolio that builds predictable outperformance that we can plan around over the long term to integrate into the rest of someone's strategies.
This episode of More Than Commas is brought to you by Sound Financial Group, where we help families and business owners build and protect wealth through clear, long-term financial strategies. Whether it's retirement planning, investment management, or navigating your overall financial strategy, we're here to help guide you every step of the way. To learn more about how we can help you secure your financial future, visit sfgway.com. You can run retirement calculations and download content to read in your own time.
So this is a look back just to observe some different things that happen over some different periods. This is comparing the S&P 500 to a couple different Vanguard portfolios and a couple different portfolios that we might use inside of the Dimensional Fund Advisors ecosystem. And you can see 2012 back to 2002, which does include that mortgage crisis right there in the middle, that over that long-term period, the S&P only averaged 4% a year versus 8.5% in a 100% stock, very diversified portfolio, which also includes, just for the sake of argument, a 1% average advisor fee over that time period. That may be more or less than someone might actually experience in a portfolio. I wanted to put something in there just to acknowledge that those portfolios with Dimensional are usually including an advisor like us. So it is worth putting that into the mix. So over that period, which is in still relatively recent history, we see 4% per year from the S&P versus a range of outperformance, except for one Vanguard 80/20 in that mix. Next time slice, year to date, January through March 2025. Now, when we annualize this, and this might throw someone for a loop if you've been paying attention to the actual numbers we see, this is if that January to March return got annualized over the course of the rest of the year, then the S&P was starting on a pace for negative 16% for the year versus 2.6 positive for the year for the diversified portfolios, both 2.6 or 2.8 for the 80/20, again, with these already taken out. And then finally, so if we're looking at 2002 to 2025, which is what a lot of folks have looked at, this long period of outperformance from the S&P 500, yes, we see that the S&P is, over that long-term period, is outperforming the other portfolios on this list by a larger margin for some, but a fairly narrow margin for others, although 1% ish over 20-year period does start to compound over a long time. But this is where we have to think about the difference between some of these long-term back tests and what was actually happening in someone's life. Whether you were, if you started 2002 with $200,000 in a portfolio and let it just grow through 25, that produced a great result from the S&P. But if you were putting money in at all or taking money out, then those specific large ranges and intermediate term periods where it was vastly underperforming really start to make a difference when we take into account how money is going in and going out, the timing of returns and the timing of your actions in your account. And so that's the context that I wanted to add for something like this, where you might say, oh, over the last 20 something years, the S&P that's the asset class to go for. Why don't we just go all in on that? Well, that is what we see for this long-term period, although based on slightly shorter term periods that we've seen in its history, if now is the time that you're thinking about going all in on the S&P 500, one of the things we start to worry about is, when do we start to see some of those same patterns happen again? Something we call reversion to that mean that the S&P has seen, that average return over the long term. Is it going to snap back to that? Those are all the questions that come into picking one asset class and going all in on that asset class. It could produce some very, very good rates of return, although we have seen that you don't have to play that game to get a very predictable, over the long term, outperforming portfolio that you can build your plans around. That's what that diversification brings to us. That's what that academically allocated, globally diversified portfolio really delivers. And then one more piece of data, just to take a really long look back on the S&P. This was also appearing in a podcast we did recently about long-term memory loss in the financial advising industry and recency bias. And we just took a sample set of the S&P 500 from 1937 to 1951, which was averaging 8.3% over that long-term period, and a diversified portfolio, which, if you haven't listened to that podcast, we'll put a link below. We put together a portfolio that is not exactly what we can invest in today, because it's just US based indexes that we can put together, because we didn't have good data on international until about the 1970s. So put together a approximation of the mix of a diversified portfolio that academic research would suggest today, but just US, not international. So that diversified portfolio, again, outperforms versus the S&P over most of these periods, and especially over that long-term period. Those are some of the dangers of going all in. Would love to hear some of your thoughts or comments on what you've seen in investing in the S&P. If you've been in it over the long term and what your experience has been, we'd love to hear about it. So thanks for tuning in, and next time we'll come back with more strategies and insights into finance to help you design and build a good life.